Now that we know how to classify leases, we need to learn how to account for the two different types of leases. We'll start with finance leases first. So with the finance lease, we could essentially break down the life of the lease into 4 different journal entries. Obviously, as we saw earlier, when we first take out a lease, we're going to record both a lease asset and a lease liability. So the first part will be recording a lease. So if you think about what's happening with the lease, we are paying for the right to use the asset. Since we have control over it, we record a right to use asset. So we'll debit right to use asset. Second, by signing a lease, we're agreeing to make future lease payments. So now we have an obligation to make these future payments. So we're going to credit a lease liability. Right, the amount we're going to record for the asset and the liability is going to be the present value of our lease payments plus the present value of any probable expected residual value owed. Right. Second, after we record the lease, we're going to have to make lease payments. Now, if we think about what's happening when we make a lease payment, obviously we're going to be paying cash. Right, and we'll just credit cash for the amount of the lease payment. Our debit here, so if you notice up above, we've recorded a lease liability which reflects the future lease payments we have to make. So every time we make a lease payment, we're reducing the liability. So we'll just debit the lease liability. Okay. The third type of journal entry we'll make is recording interest expense. So when we dealt with asset retirement obligations, we ended up recording an interest expense to reflect the increase in the present value of the ARO. Same thing when we covered pensions, since the projected benefit obligation, or the PBO, is recorded at present value. Over time, we recognize interest expense to reflect the increase in the present value of the pension obligation. So same thing with this finance lease. Since when we recorded this lease, we recorded the lease liability at the present value. Over time, we're going to recognize interest expense to reflect the increase in the present value of the lease liability. So this tells us we will debit interest expense, and then our credit here will be to the lease liability. Right, and then just as a note here, recording interest expense reflects the increase in the present value of the lease liability. All right, and then the final journal entry we'll make is to record amortization expense. Now the idea here is when we first recorded the lease, we capitalized the asset, so the right to use asset. Over time, as we use this asset, we're then going to expense it. It's called amortization expense here instead of depreciation expense, like when we purchase an asset, because with a lease, we just have the right to use an asset. It's an intangible asset, essentially. So we will debit amortization expense here. And then for our credit, it's just like other intangible assets. We can directly credit the right to use asset. Because as we use this asset, we're using up our rights. So now that we have the big picture behind how to account for a finance lease, let's apply this to an example. All right, so in this example, Caterpillar and Sterling Construction sign a lease agreement. Caterpillar is the one leasing a backhoe from Sterling. All right, and so here we have all the lease agreement terms and the data. So again, the first journal entry we make is just recording the lease when this lease is taken out on January 1st. So on January 1st, we're going to record the asset and the liability Again, we're going to debit right to use asset. We'll credit lease liability. We'll credit for the present value of the lease payments plus the expected residual value. Okay, so then obviously we need to figure out what the lease payments are and the expected residual value. So first bullet point, it tells us the lease agreement is non-cancelable. It requires annual rental payments of $20,711.11 at the beginning of each year. So this is an annuity due, payment terms over 5 years. All right, so we have a present value of an annuity due here. That's equal to your rent times the present value factor for an annuity due. Interest rate here is, we need to determine that. So let's go down to the bottom here. All right, so it tells us Sterling's IBR, or incremental borrowing rate, is 5% per year. It also tells us here that Caterpillar sets the annual rental rate to earn a rate of return of 4% per year. Sterling is aware of this rate. So again, when you have two interest rates, you'll use the implicit rate if it's known. If not, then you can use the IBR. So since Sterling or the lessee is aware of the implicit interest rate, that's the rate we'll use. So we use 4%. And the number of compounding periods is going to be 5 years since these are equal annual rental payments. So n is equal to 5. So if we take the present value of this, which is shown on the next slide, we can look up the present value factor. Present value factor of the lease payments is equal to the 95,890 roughly. All right, second, we need to include the expected residual value. So here, the backhoe has a fair value of the commencement of the lease of $100,000, estimated life of 5 years, and a guaranteed residual value of $5,000. Sterling expects that it's probable that the expected value of the residual value at the end of the lease will be greater than the guaranteed amount of $5,000. So in this case, our expected residual value is going to be higher than the guaranteed amount. So we would expect to pay 0 for the expected residual value. So that means then we'll just record the right to use asset and the lease liability at the present value of the lease payments of 95,890 roughly. Again, I just rounded this number. So if you're following along, you're slightly off, no problem. So now, if we look at this first bullet point, it tells us the lease agreement is non-cancelable, requires equal rental payments of $20,711.11 at the beginning of each year. So also on January 1st, besides recording the lease asset, we are going to also make our first lease payment. Again, if you think about what's happening here, we're just paying this $27.11 in cash. So we'll credit cash for this $20,711. I'm just going to round this off here. And then each time we make a lease payment, we're reducing our obligation to make future lease payments. So we'll debit the lease liability. So also be for $20,711. Okay, so we've gone over recording the lease asset and liability, and we've gone over recording the first lease payment. So after making the lease payment, as it hits towards the end of the year, we're going to have to make an adjusting entry to record interest expense and amortization expense. To figure out the amount of interest expense, we can use a lease amortization schedule. The schedule works in a very similar manner to an amortization schedule for a bond discount or premium. So in the first column, the annual lease payments, it's fixed over the lease of the term in this example, so it's always going to be the same. Again, the lease payment's given in the terms of the lease. All right, so notice on January 1st, 2017, this is the date we first took out the lease. we're making this lease payment. Since on this date, it's impossible for us to have accrued interest, the total amount of the lease payment goes towards reducing our lease liability. Right, so our lease liability is brought down to $75,179. Now, as it hits the end of 2017, as I mentioned, we need to accrue interest and we need to record amortization expense. So on December 31st of 2017, right, we're going to record our interest expense. So we'll debit interest expense and we'll credit lease liability. Right, again, this interest expense just reflects the increase in the present value of the lease liability after 1 year. So to determine our interest expense, we'll take our beginning value of the lease liability at the beginning of the year, the $75,179. So our beginning balance in the lease liability. We'll take that balance and we'll multiply it by our interest rate. So in this case, our interest expense for 2017 will be the $75,179.24. And we use the interest rate of 4% to calculate the present value. So we'll also do that to calculate the interest expense. If we multiply this through, we'll get out to roughly $3,007. Right, so that will be our interest expense and our increase in the lease liability for the year. Again, I'm just going to round this off. Okay. The second thing we need to do at the end of the year is record our amortization expense. Right, as I said above, we'll debit amortization expense and we'll credit the right to use asset. Now to amortize this, we're just going to use straight line amortization in this class. Right, remember, we're just allocating the cost of the right to use asset over its useful life. So we originally recorded the right to use asset at roughly $95,890. We're just going to split this evenly over the useful life of the asset, which is 5 years. Right, and if we do that, we'll get out to roughly $19,178 per year. So that'll be our debit and our credit here. So let me just point out here, you'll notice we're directly crediting the right to use asset. Some companies, they use accumulated amortization, but your book directly credits the asset, so we're going to do the same. All right, so this next slide just covers the amortization, which we just did, so we'll move on. All right, so again, these two journal entries were done at the end of the year as adjusting entries. So recording the interest expense and recording the amortization expense. So at the end of the year, when we report lease assets and lease liabilities, these are going to be reported separately from other assets and liabilities on the balance sheet. Alternatively, the company could disclose the lease assets and liabilities in the notes to the financial statements. So just like with any other long-term liability, the currently maturing portion of the lease liability is listed in current liabilities. So in other words, the next lease payment, which is due on January 1st, is listed in the current liability section. The rest of the lease liability gets reported in the non-current section. Right, for our income statement, we'll list both interest expense and amortization expense. So now let's go into the second year. So in the second year, if we think about what's happening here, on January 1st, we're still going to make the lease payment. Right, this journal entry is going to be the same as the one in the first year for the lease payment because in this example, we have fixed lease payment terms. So again, the payment's $27.11. We'll decrease our lease liability, we'll credit our cash. Again, when it hits the end of the year, we need to accrue interest expense and record our amortization expense. Our amortization expense is going to be exactly the same, because we're recording this on a straight line basis. However, for our interest expense for the second year, since we're using the effective interest method, this amount will change. Again, how we calculate this, though, is the same as in the first year. We're just taking our beginning balance in the lease liability, and we're multiplying it by the interest rate. So in the second year of 2018, our beginning balance is $75,179.24. We'll multiply that by the interest rate, and we'll get out to 299.01. Right, so we'll debit and credit interest expense, or we'll debit interest expense, credit lease liability for that 229.01. Right, and then year over year, you'll follow the same process. The payment occurs at the beginning of the year. This stays the same. Get amortization expense will stay the same, but your interest expense is going to change from period to period since we're using the effective interest method. And then the last thing we need to cover for leases, or for finance leases, is what if the company decides to purchase an asset at the end of the lease term? So if Sterling purchases the equipment from Caterpillar at the termination of the lease at a price of $5,000 and the estimated remaining life of the equipment is 2 years, it makes the following entry. So you'll notice your entry here for the $5,000 is just like your entry for the purchase of any type of asset. You'll debit the asset account for the price paid, and since we're paying cash here, we're crediting cash for $5,000. So now that we know how to account for a finance lease, we need to cover how to account for an operating lease. So as I mentioned earlier, the way we account for finance and operating leases won't affect our balance sheet accounts, but it will affect our income statement accounts. So under an operating lease, we're going to use how we account for finance leases as a baseline to learn how to account for operating lease. There's a lot of this is going to be similar. So when we first record the lease, we're still going to debit the right to use asset and credit the lease liability. In fact, how we account for recording lease is going to be exactly the same. Same thing when we make a lease payment, the accounting is going to be exactly the same because the transactions are similar. All right. Then, as I mentioned, the accounting for income statement accounts will be different. So how we record interest expense and amortization expense will be different. So for operating lease, we'll record both interest expense and amortization expense in one journal entry, and we'll record it in the lease expense account. All right, so this lease expense captures both the interest expense and the amortization expense. And for operating leases, the lease expense will be equal to the annual rental payments, or annual lease payments. Our credits here are going to reflect the credits that we used for the finance lease. So we'll credit both the lease liability and the right to use asset. All right, so you can kind of see how this parallels the journal entries for a finance lease. To calculate the amount of the credit for the lease liability, we're going to use the effective interest method. So the same method that we used for a finance lease. And then the credit to the right to use asset, this is going to be a plug number. So all I mean by a plug number is that we're going to amortize the asset in such a way that the lease expense is the same every period. So in other words, for our debits to equal our credits in this journal entry, our credit to the right to use asset is going to be the difference between the annual lease payments less the amount of interest expense in each period. So let's go through an example here. All right, so in this example, Josway is the lessor, Trailer is the one taking out the lease. So we'll be doing the journal entries from the standpoint of the lessee or trailer stores. So first step in any lease problem is to figure out what type of lease it is first. We're not going to go through that process since we're trying to cover the journal entries for operating lease. So clearly this will be classified as an operating lease. You'll notice if you look through this example that we are not told what the lease payments are going to be. Right? Also, we're not told what amount that we would record the lease asset for. So we need to figure that out. So in this example, we're told the implicit rate of Josway is 6%, and Josway is the lessor. So again, the implicit rate refers to the lessor's required rate of return. And in this case, it's 6%. So pretty much the lessor is going to set the rental payments or the lease term payments to earn this 6% return. So if we discounted the lease payments back to present value, the lessor should be earning 6%. In this case, the fair value of the equipment being leased is $60,000. As a lessor, you would want to at least earn the fair value of your leased asset. So here, the fair value is the amount the lessor is trying to earn in total with the equipment. Right, so to earn that fair value of $60,000, it could lease it, but it could also sell that equipment. In this case, the equipment has a residual value of $12,000 at the end of the lease term. Since the equipment has a residual value of $12,000, this means the lessor could sell the equipment for $12,000 at the end of the lease. So the amount the lessor has to earn through the lease payments will be the $60,000 fair value minus the present value of the residual value. Right, so key word here is we need to take out the present value of the residual. So we can't just subtract out the $12,000 residual value because this is the value at the end of the lease term in 3 years. So instead, we need to calculate the present value of the residual. And to do that, we could use the present value of a single sum. All right, so that's done for you on the next slide. That part should be review. Right, the lease term is 3 years, and the interest rate was 6%. So n is equal to 3, I is equal to 6%. If we calculated that back to present value, we'd get $10,075 roughly. So then that tells us the amount to be earned is the $60,000, or the amount to be earned through the lease payments is the $60,000 minus this $1075.44. Right, so that gets us out to $49,924.56. So this $49,000 is the present value amount that the lessor has to earn in lease payments to earn a 6% return. So I should say this is the present value amount. All right, since the lease prepayments are made at the beginning of the year, we know we have an annuity due. So we'll set, to figure out the rental payments or lease payments, we'll set this up as a present value of an annuity due problem. And we know this is equal to your rental payments plus the present value factor for an annuity due. All right, so the present value of the annuity due is what we just figured out. It's $49,924.56. we're trying to solve for the rental payments, and we'll just multiply that by the present value factor. Again, in this case, n is equal to 3, y is equal to 6%, so we can look up the present value factor. And if we look that up, we'd find the present value factors 2.83339. Right, so from here to solve for the rental, we just divide both sides by the 2.83339. Right, and we'll find out the annual rental payments must be equal to $17,620.08. Alright, so now we figured out the annual lease payments of $17,620, and we know that the present value of these rental payments is $49,924. So we have all the information we need to have to record the lease asset and liability and to make that first annual rental payment, which again, these payments occur at the beginning of each year. So on January 1st, we'll record the asset. So we'll debit right to use asset as before, and we'll credit the lease liability. Again, we set to record these equal to the present value of the lease payments. So in this case, we determined that previously to be the $49,924. So we record both of these amounts. Again, I'll just round off to keep this more simple. And then second, let me just copy this down. Second, to make our lease payment, again, these lease payments occur at the very beginning of the period. Each time we make a lease payment, we're crediting cash to reflect our payment. And each time we pay that payment, it reduces our liability, so it'll reduce our liability account. Again, we just determined the annual rental payments are the $17,620, so that'll be our debit and our credit amount. So this next slide just covers what we went over, how to record the lease asset and liability, and then recording our first payment, so we'll skip this. Right, and then as I mentioned before, at the end of each period, we need to accrue our interest and record our amortization expense. So this will be done at the end of the year. Right. Again, when we go to record amortization and interest expense under an operating lease, we're going to record it under a single lease expense. Right, so I'm just going to copy down this journal entry from above as before. Right, so as I mentioned, your lease expense each period will be exactly equal to the annual lease payment. So our lease payments are $17,620. We'll set the lease expense to be exactly the same. To calculate our lease liability, it's the same as before. Again, the lease liability reflects your interest expense. And as we said before, your interest expense is just equal to the beginning balance in your lease liability. And we'll multiply that by the interest rate. So in this case, our interest expense, at the beginning of the year, we originally recorded the lease liability at $49,924, but we instantly made a lease payment. And since you couldn't have accrued interest expense on the first date, the total lease payment reduces the lease liability amount. So if we take our $49,924 beginning balance, we take out that first lease payment, we're out to our beginning balance on our lease liability of $32,304. Right, we'll multiply that by our interest rate. The interest rate we use to discount the lease payments back to present value was 6%. This was the implicit interest rate. And so if we did that, we would get out to $1938.27. Right, so we'll make a credit here for this $1938.27. Sorry, typo here. Right, and then the amount we're going to credit the right to use asset for, this is just a plug number. We're going to set the amortization expense so that our lease expense is the same every period. So this lease asset will just be the difference between the lease expense and our interest expense. So we'll credit the right to use asset for $15,682. And again, this credit reflects the amortization expense. So we've just made the journal entry here for recording lease expense. To determine your amortization expense, your book uses what they call a lease expense schedule. All the schedule is showing is that the amount of amortization is the difference between our lease expense and our interest expense. So it just shows the same thing we've done here. Although I think creating a schedule for this is unnecessary, and I think most people it will just make this more confusing. So we'll skip past this. And then this slide is just showing our journal entry to record lease expense at the end of the year, which we just did. So going into the second year, we're going to follow a similar process. Again, at the beginning of the second year, on the January 1st, the company is going to be making a lease payment. Right, this journal entry is going to be exactly the same as before. Right, because the payments are still in the amount of roughly $17,620. At the end of the year, the company is going to again record a lease expense. The lease expense is equal to the annual rental payments again. And then to figure out the lease liability, follow a similar process before. We'll take the beginning balance in the lease liability account and multiply by the interest rate. And then the right to use asset, again, will be the difference between the lease expense and the lease liability. So the journal entry we're making here follows exactly from the lease expense schedule. Right? If it's December 31st, 2018, our interest, we would have calculated this out to be $997.41, which means the amount we're reducing or amortizing the right to use the asset by is the difference here for roughly $16,623. And then going into the third year, again following the same process. Notice here in the last year though, we have a zero interest on the liability. This is because at the beginning of the year, we would have made our last payment for the lease, which then would reduce our lease liability to zero. In turn, we wouldn't have any accrued interest over the year.